So I just wanted to thank everybody that can make it out today to this event, the Winning with Options event. Thank Marvin and thank Thomas also for just presenting this for us. It should be pretty interesting. We're all investors. A couple of us are, wanting to do a little bit more, make a little bit more money with this current climate of just very cheaply valued stocks. To be able to make some money while we get this recovery, and I think that we can learn something here, and we can figure out just different strategies that we can use to do that with options. And Thomas is going to do the presentation, and we're going to eat also while we go ahead and get started. Then I'll get you something right now.
Just to reiterate what Stephen said, we're not here to sell you anything or tell you how to invest your money. Share with you the benefit of our knowledge and experience with stock options over the past 20 years or so. Now let's go to the next chart. Before you make any investment, whether it's real estate, stocks, options, you really need to understand the big picture. And what I mean by the big picture, if we look at the Dow Jones Industrial Average over the past 100 years, and we break that up into, say, 30-year blocks, we begin to see something pretty interesting. Is that you have about 20 years, and this was back when the Dow started, 20 years of a flat period. The market was pretty much going flat, didn't do anything. And all this was during the Industrial Revolution. But then you had, this runaway stock market leverage, which was a driver for the market that really drove it up. And then you had, the market going up for about 8 years. Let's go to the next chart. Now, something very interesting. If you look at the next 30 years, 37 years, you begin to see a pattern. Right? You've got a period where the market's going flat, followed by some major innovation that drives it up. It goes flat again. And this was during the Depression. In this case, you had automation was really driving the market, and that drove it up. Now, go to the next. Now, this is something we can relate to, is that the internet boom. That really jump-started the market and drove it up. But now, we're in a period of where the market is going flat. Now, how long is this going to last? Who knows? And what's going to be the next driver to drive this up? It's going to come from innovations that you generate. It could be nanotechnology, who knows? But the point here is that you want to start with the big picture so that, when you make your investment decisions, it's not based on what you think, what you feel, or your emotions, but what is the chart telling you? Now let's go to the next one. Now, during this flat period, and this started, on the other chart, you have questions.
Can you explain that again? Not based on emotions, so what is the chart telling you?
Well, here, let me get to it right now. During the flat period, started here in 2000. Okay? So now, if you had bought, say, $10,000, worth of some stock in the Dow, or 10,000 shares, and today you'd be lucky if you were still eating. Right? Because the chart, if I go back to the other page there, it's telling me not to expect any runaway growth. Right? That the market is going to be pretty much range bound. Now that's not to say that you still cannot make money in here, because this is a 4,500 point swing in the Dow. Okay, but knowing this, how you've got a period of going up, and you got a period going down, and it's pretty much within this channel. And right now we're sitting here at about 1074. Right, so is the market now going to start to come back down? It might. But in terms of just running away, I wouldn't expect it. I'd be looking more for the market to, test this area up here. Does that answer your question?
Yeah,
Now, let's get into options. What is an option? Now, in this illustration, I'm going to use real estate. Okay, because back when we had, the big housing boom, you had, if I change this to speculator, you would have speculators go out and say, hey, I'll give you $10,000 for the right to buy your house at $100,000 for 30 days. Okay, so the owner says, hey, I'll sell you that. Now, why is he doing that? Because he knows that there's a pool of buyers down here that he can potentially sell it to. So in this example, the homeowner is the seller of the option. Right? He's going to sell it to this speculator for $10,000. The speculator then says, he goes out to the marketplace, hey, what can I get for this house within those 30 days? Now, if he doesn't come up with a buyer in 30 days, he loses. But the market is hot enough that he finds a buyer for $130,000. Okay? So he says, hey, I found a buyer. So he's going to pay the homeowner $100,000. Okay? But he gave the homeowner $10,000. Okay? So now the speculator, who's the option buyer, is going to profit $20,000 in that 30-day period. Do you understand that? Because that's pretty much the whole concept of options. Any questions on that?
So you have a time period. You're looking to sell the option.
Right. That's
you can
very
tell
important.
you can get as much as you want, but you have to sell it for that amount that you
That time period. So, time is working against this guy. Right? Because if he doesn't come up with a buyer in 30 days, he loses. And the homeowner will just turn around and he'll sell another option.
So it's the option seller that really is profiting from this whole transaction, because the buyer is coming to them and they're doing the work and they still get the $100,000. Okay.
The option seller in this case, he gets the $10,000 which he keeps, and then he's going to turn around and also get the $100,000. But the option buyer, he made out too, right? Because he was able to find a buyer for $130,000. So he profits $20,000 for 30 days' work, which isn't bad. And back when you had the real estate bubble, people were doing it. Let's go to the next chart. So if I change the house to stock, it's the same thing. It's identical. Right? Is that the option seller, he's selling the right to the option buyer. And he's got to come up with a buyer for that stock within that 30-day window. So the analogy is the same. Just replace stock, replace the house with stock. Okay? Now, there's two types of options. You have puts, and you have calls. The calls, when you're buying them, you're buying the right to buy something at a specific price. Okay? With the puts, you're buying the right to sell something. Is that if I buy the put, in other words, if I were to buy a put from you,